This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is a show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, we got a great show for you today. We've got a return guest here, somebody I'm sure you've been wondering what he has been up to since this December 2016 interview that we had with him when he was, just kind of moving forward in real estate investing. If you're wondering who I'm talking about, that's right, Lane Kawaoka. Yes. Now, we love Lane for one simple reason here. We say our motto here is cash flow is king. Well, that's the name of his podcast, not Cash Flow is King, but it's called Simple Passive Cash Flow. Okay, so this is the guy that's all about cash flow too. So this makes it even better. But Lane was a guest on the Old Dogs REI Network in December of 2016 on episode 061, and it was entitled W-2 Employee Kicking It with Real Estate Investing. Lane, as I mentioned, is the host of the Simple Passive Cash Flow podcast. He's an avid real estate investor and a full-time W-2 employee as a civil engineer who got started young with passive real estate investing. The last time he was on our show, he owned 11 single-family homes in Birmingham, Atlanta, Indy, and Pennsylvania. Now, we'll get an update on that, I'm sure, soon. As he slowly built his single-family portfolio, Lane realized that the single-family homes were not going to get him to his cash flow goals. And he was creating a job for himself to be a manager of the managers. So today, Lane is primarily a passive investor, a limited partner in syndications, representing over 10 apartment buildings, and that's over 1,400 units. Now, this has all happened since December 2016, a little over a year here. So I am really interested in hearing the latest and greatest from this great friend of the Old Dogs REI Network. Lane, welcome back to the Old Dogs REI Network. How are you?
Hey, Bill. Thanks for having me. I didn't realize it was way back in 2016.
Can you believe that?
No.
I mean, you were still collecting Monopoly houses that time, and you're trying to get the hotels. And, you're now you've got, all the hotels, and I don't know, maybe you dumped the houses. I'm not really sure, but we just want to, touch base with you. And here there has been sort of a shift here, some sort of a symbiotic shift in your focus. And I kind of want to know, what you're doing now and why. So why don't you just kind of update us? What are you doing since December 16?
Yeah. I mean, you kind of hit it right in the head. It's definitely a big shift. I mean, my first 30, 40 podcasts were kind of all about beating the drum of the turnkey rental. And, don't get me wrong, great way to get started, but definitely shifted away from that. It's been kind of like one of those Korean dramas. All my listeners have been like, "What? What? You're changing? You're changing?" Like, yeah. So I joined one of those apartment mentoring groups. Paid like a gazillion dollars for that, and started because I wanted to be like an apartment lead, right? I think everybody has that dream of I'm gonna go out and lead a 100, 200 unit building, syndicate all the money, and then it was just kind of a couple of things, it's just there's no deals out there. Even like a few years ago, I went out there and I analyzed like 5, 10 deals a week, and I just realized that all these properties were just garbage properties that just didn't make any sense, and I was like, how the heck are people buying stuff? And it just got really discouraging because over a period of like 18 months, I analyzed at least 150, 200 deals. And, it takes 20 minutes to put through the analyzer. And so that's a lot of time. And not only that, like trying to build rapport with brokers. I mean, unless you're looking to travel to these places like a few times a year to get in front of the brokers, you're just not going to do it, dude. Like, and I was living in Seattle at the time, trying to find properties in the Midwest, Texas, and the South. It just wasn't going to happen.
Well, it's interesting. You mentioned you were in Seattle, but you're not in Seattle as we speak. There was a shift there too. Do you want to talk about that?
Yeah. I mean, I'm pretty frugal guy, and for me, the numbers have got to make sense. And as at that point, I was kind of getting nowhere for like about a year. And, I had some liquidity saved up because I had sold my primary residence to kind of, you need about 100 grand at least to kind of, get into multifamily for hard money and different expenses and, to kind of front a lot of the syndication costs. So I had some cash just kind of sitting there. And like I said, I wasn't getting anywhere. So I needed to add to my resume by being a limited partner in a deal to at least say, I own 150 units or in part of a group that does, to get a little bit more street cred with the brokers.
And why don't you just explain those that don't know what is a limited partner in one of those? What does that mean?
Yeah, so the analogy that's used a lot is an airplane analogy, where a syndication is sort of like an airplane. In the airplane, there's the cockpit, which holds the general partners. Now, the general partners have different roles. There could be one guy, can be a lot of people, but these are the guys who find the deal, they find the lending, they manage the deal, they figure out everything to do operationally. They're the boots on the ground, and then they sign on the loan, and they're basically that first line of defense for liability too. And in case there's trouble and the loan comes due, those are the guys that kind of step in first. Those are the general partners, again, the GPs. And in coach, you got all the limited partners. So everybody, they put in $25,000, $50,000 as a passive investor. They sit down and coach, they kind of shut up and they go to sleep and they cash their checks. And that's how the syndication goes off. And it kind of works pretty well because, if the plane goes down, everybody kind of dies. So, the general partners are incentivized to do a good job because not only are they putting their own money on the line, and in this case, their life, in real life, they're putting their brand on the line and a reputation. So, these deals are, pretty decent returns. I was thinking conservatively 15 to 20% a year, where, when you're doing single family homes or turnkey rentals, I mean, you can probably make 20, 30% a year, which is higher. But, with my 11 single family homes, I was getting about an eviction or two a year and, 4 big catastrophes that happen every year. And that was only for what, $3,000 passive a month. I mean, my goals were like 3, 4 times that. So, 30, 40 houses. So that's an eviction every month and a catastrophe every month. That was creating a job for myself, what I saw. And, I'm not accredited yet, but, I just did the math at 15 to 20% a year as a limited partner. I mean, I not quite at my goal, but I'm going to be at my goal in a few years, I figure. So why take on the extra headaches of being a general partner?
Interesting. Do you still have the single family homes?
Yeah, so I'm been trying to sell them off for the last year. And, a lot of my single family homes are pretty good. Like, they run for more than $900. And it's just been taking a long time to sell them. And that's why I tell people don't go buy duplexes, triplexes, or quads, especially if you're, a high net worth professional. Your trajectory is much higher. You're going to go to syndication. So all the small stuff, they're just sort of like stepping stones to get to that location. So, I mean, I kind of just did the back of the envelope thing, which usually involves Google Sheets, and extrapolated out, at 15 to 20% a year where I would be at. And I was kind of like, well, now's the kind of the time where, you get to kind of take profits off the table in a way and create your lifestyle today. So that's why I kind of made the move back to Hawaii, where I grew up. Because the only reason I lived in Seattle and froze my butt off in the whole year was kind of for money. I mean, Hawaii was home for me, and everybody likes Hawaii.
Now you've got an engineering job in Hawaii?
Yeah. So I still keep the day job. I mean, I think the important thing there is, I've kind of moved to more less stressful jobs. I was in, initially I was in, a high stress private company in construction 24/7 job, but kind of gravitated away from that after, part of that just not being the new guy at work anymore, trying to find a better job. And, part of that is like, I don't need to take the 10 to 15% pay increase for about 50% more BS at work. It's just not a good return on investment for me in terms of time.
Sure.
Especially with all this investing.
Isn't everything kind of more laid back in Hawaii just in general? I mean, isn't it, everybody looks like those guys in Hawaii 5-0 walking around Hawaiian shirts, and you don't have to wear suit and ties and stuff.
Yeah, it's kind of lunchtime all the time, it seems like. People don't tuck in their shirts. Things move a little bit slower. I mean, no different than any other tertiary town in America. I mean, no different.
Right. Well, that's interesting. So you basically had obviously the income enough coming in to be able to move back to Hawaii. And it's funny, when I was talking to you back then too, you didn't seem real motivated to quit your W-2 job. I mean, at one point you wanted to, but you weren't in a big hurry. Are you more motivated now, or is it, something you're going to hang on to as long as as long as you want?
Yeah, I mean, people tell me all kinds of different things, different mentors. I mean, I think most people, their goal is to leave their day job, and me included. I don't particularly like it, but it does several things. It keeps you very patient, and I like working with people with day jobs because I always feel like if they're doing this real estate stuff, it's not to put really food on the table. It's more kind of for fun. Like I can tell with you, like doing the podcast, it's not really for money, and that's why it kind of works so well for you. And it kind of shows through, and just when things get tough, I think people will choose their family and putting food on the table than me, their partner, is what I kind of figure. So that's why I like the day job. But I always feel like that recession is looming. I mean, it's a wise choice to just hold on to the day job, because that's kind of, if you can ride that out for one more half cycle, I mean, you'll be way ahead of everybody else. I mean, like they say, you got to be collateralized going through a recession.
Oh yeah, and there's I'll tell you, when I started pretty much full time as a real estate investor, and I'm living the life now. This is great, and I did my taxes, and look at this, I don't have to pay any taxes because I had all these capital expenditures and everything. In fact, I had like a negative, income on my taxes. Wow. Well, try to get a loan, try to get a refinance when you've got a negative tax income. I mean, yeah. It was like, I was ready to get a job at Walmart. So I had a W-2 income. I think it would have helped, getting the decent rates, but instead I had to pay these ridiculous, not quite hard money, but I mean, it was still horrible rates when guys are getting 3s and 4s at that time, and I'm paying 7.5, 7.8, and I'm going, guy, so, yeah, there is something to be said about the W-2,
Right.
that is actually pretty nice when you're dealing on the side, but you still got the pressure a little bit on the trying to find the time. And that's a question that, comes to mind is how much time can you really give to real estate investing when you are working full time?
Right. And I think to your point, like you're exactly right there. You got to qualify for the loans, but I'm to a point where everything I do is syndications, and especially being a limited partner, I don't care what my credit is. So it's something to think about before you leave your day job for sure. If you're still buying single family homes or needing to qualify for, I don't even think commercial financing you really need a credit score, to be honest, or credit, or that debt to income.
Yeah, I mean, they just, yeah, you're right. Most of them, I mean, the good loans and the ones that you would want to get for the good properties are non-recourse. And so, it's not a big issue. Yeah, you have to have a sponsor and somebody that's got the net worth to be at that level of the purchase price and the liquidity. But, if you're a limited partner, it doesn't matter. Like you said, your credit rating, they just care about your, that initial investment there.
I mean, I've kind of started screwing around with all like the travel credit cards and getting points and doing that little side hobby I like to do again, because I don't really care about my credit score anymore. It's kind of funny.
Yeah, that's wild. Kind of back to that question, 40-hour work week, where are you kind of squeezing out your time to, I'm sure you're probably looking at the sponsors or the general partners, trying to find the right kind of investments in the syndication world. What kind of time do you cut out per week to do that?
Yeah, I would say, I'm kind of different from most people because I've got the podcasts and do that kind of stuff. So, that aside, just with pure investing, I'd say you just got to carve out a couple hours every day. You get to work, you got to come home, you can't watch Netflix, you got to do this. And then you got to carve out a nice chunk on the weekends to kind of catch up on stuff. And then, I mean, a big thing is traveling to a lot of these conferences and, meeting people face to face. Because a lot of what I do these days is hunting for the deal hunters. I don't look for deals. I look for the people putting together the big deals.
And where do you find those guys, and what kind of criteria are you looking at when you're looking at one of those guys?
Yeah, I mean, number one, I would say it's likely not to be at your local RIA. I just haven't found too good of a quality who's just gonna not buy a plane ticket. I mean, so that's the big thing, right? You got to buy a plane ticket. You have to go and pay more than $500, $1,000 as an admission fee, and you get in a room with a much higher quality group of people, much more serious people. And I think the important thing is not really to go find the deal sponsors, but find the limited partners that are disinterested about, they don't have a dog in the race, so to say, and you could get to know people and ask where are they investing in.
Gotcha. Do you kind of set criteria for yourself? Like, I mean, you're looking for somebody that's done, 5 or 6, 10 deals, that's got a track record. What are you looking at when you're looking to invest?
Well, I mean, on the deal side, I got the mentorship to analyze the deals. So I'd say that's half of it, right? Because good leads do bad deals. I mean, that's something to realize. Like, as a new apartment investor, yeah, I wouldn't invest it with you. That's for sure. Unless I really, really knew you well. And when you're starting out, you give a lot of returns up to your limited partners. Just a simple split will be like a 90-10 split. Where 90% of the returns go to limited partners and 10% go to general partners. Now that's a split that's very heavily skewed toward the limited partner, and that may be done because the limited partner is new and inexperienced, so they have to kind of give up more. But a lead is always getting more experience and always building their investor list and getting more popular. And as that happens, then the transition to being someone like Ken McElroy. I mean, that guy has probably the best track record of everybody, and everybody kind of knows about him. And he can kind of charge whatever he wants. So that's kind of the two ends of the spectrum. So me personally, I like to stay in the middle. Guys who've done a few deals, who haven't totally taken away all the profits away from the limited partners. I feel like there's a sweet spot in there.
Now, not being an accredited investor, though, does that knock you out of some of those deals? Like I would imagine a McElroy would only have accredited investors.
Yeah, I would say so. Like I think he only does accredited investors, but you've got to look for guys doing 506B like Boy on deals where they're owning out to a private network, and it's your kind of job as a non-accredited to kind of go around and build a relationship with people, make them feel comfortable, because a syndicator's worst fear is that if a deal goes south, you're going to sue them for something that some misleading that was in that PPM that maybe you didn't see, or some syndication attorney can kind of represent you on your half. So for a syndicator's point of view, to bring in non-accredited, it kind of makes no sense, because it takes so much effort to educate a non-accredited. Once the non-accredited's in a couple deals, they've kind of spent all their money. They don't have that much money. And it's kind of dangerous, to kind of navigate those gray SEC rules.
Right. No, that's a different. It is a different market. I mean, a different market of investor. Along those lines, have you ever done any crowdfunding? Actually, going to a crowdfunding site and invest?
No. I mean, I've always gone direct. I mean, those crowdfunding sites are great. But I think if you're willing to go around and network with people, you're going to capture a lot of the true profits. I mean, the crowdfunding sites, they're just another middleman. A lot of times you can go to a crowdfunding site and then do your own digging. You can go direct to the lead if you're smart and you know how to work the system. And you'll find what kind of a profit that middleman is taking. So, and a lot of times I kind of feel like, I don't know. I mean, it makes me question why those deals are up there. I mean, can they not find investors on their own? Like why?
Right. Good point. Yeah.
I mean, it's kind of like a online dating website, I guess. I mean, I don't know. People are like all over the place in their thoughts on those things, but
maybe they're just shy. They've got
maybe
good
they're
personalities.
Shy. Yeah, maybe those are those are the kind of deals to go to, right? Like the guys who are shy, they're not good at marketing, but they're really good at kicking that contractor's butt and getting things done. I mean, we kind of joke around, but those are like the kind of guys I like to work with.
Now, do you like to get real involved? I mean, like you participate in a lot of other meetings with let's say between the general partners and the property management team or the contractors, or you just leave that to them?
Yeah, I mean, I leave that to them. I mean, I don't really do much here in Hawaii. I mean, in terms of operation, I mean, I get to hear about it later on. That's for sure. So that's the kind of the nice part of the role that I play. You get from a high level or like a medium level what's happening. So you can kind of take that to your other deals and you get a good breadth of knowledge. But really, I mean, that's why you kind of join in these things, because, I mean, self-awareness as an entrepreneur is probably one of the most important thing. And I realize, I'm probably not the greatest at this. So, and I don't want to be able to go into multiple dozens of deals and kind of create a syndication ladder, as I call it, and diversify over different asset classes, especially not only apartments. I mean, I think apartments are kind of overheated, but all over, mobile home parks, self-storage, different locations, and especially different partners. I mean, you don't want to give all your money to like one or two guys. That's kind of crazy, I think.
Right. Well, I like the approach you're saying, where you actually analyze the deals as if you were a general partner, though, right? I mean, you ask for the trailing 12 and the rent roll and all that. I mean, and actually analyze that deal from scratch.
Yeah, I mean, I'd say like my investors, they're they're pretty smart. A lot of my guys are like engineers, IT, so they definitely know how to do the numbers. But I would say only like 20% actually know what they're doing. So I would be willing to bet maybe like 10% of limited partners out there even know what a T12, how to really read it,
Right.
which is kind of staggering. But hey, I mean, that's just how it is, right? Like, I mean, I guess that's why people put so much effort into that executive summary, and they pay like a designer to design it and make it look so pretty because, I mean, people are investing off of that thing, but I don't know why. I mean, there's really nothing in that thing that tells you if it's a good deal or not.
Yeah, you've got to go outside of the pro forma stuff, and to get to
Yeah.
the meat. Yeah.
You got to get your own P&Ls, and you got to pull the rent rolls, and you got to run your own rental comps to do it right.
And you mentioned too, you said you're investors. What do you mean by that? Now, you're not just doing this on your own, or are you working with people, directing them? I mean, what do you mean you're investors?
Yeah, so initially what I started to do was like, people would like listen to my podcasts, and then, a lot of my inner circle in there, and I've got like a little mastermind now. There, people are like, well, just tell me what you're doing. I'm just gonna kind of copy you, which I get, right? Maybe they just want to like copy for the first few ones and kind of reverse engineer it. I mean, that's how I kind of did it with homework back in college. I would just get the answer and kind of work backwards and kind of figure it out. But I mean, it's kind of, it's not that hard, this stuff, but it's very confusing as an investor, and especially navigating syndications. So a lot of these guys, they just kind of like to follow what I do, and at this point I'm trying to sell off my single family homes and kind of do the Indiana Jones trick and switch it into syndications.
Right, right. Well, in our offline conversation, you were alluding to your really just your whole approach to finance in general, and you kind of referred to yourself as sort of a minimalist and somebody who is real tight with their money. Can you kind of elaborate on that a little bit and how that impacts your investing?
Yeah, I mean, initially, I mean, that's how I saved to get all these single family homes initially. I mean, for the first 5 years, I was traveling for work, being a construction supervisor. I was living in company housing 24/7. Sometimes I didn't even spend like $100 a month on my own money. I mean, it got to be that bad.
That good, I'd say.
Yeah, I guess. Yeah, I don't know why I
Per
thought that
diem
was
and
so
all that
cool. I mean, now I think it's a little dumb. I mean, I'm just struggling to kind of, I've got some money now, like why can't I spend like at least half of what the other guy in the cubicle next to me does? So I'm trying to work on that, and just trying to be more conscious of buying value, and not trading money for time like how I've done in the past, but instead, or not trading time for money in the past, but now trading money for time. So like paying to eat out, or paying for takeout. I don't really cook. I mean, I kind of like cooking, but food just tastes better, and you don't have to clean up. You don't have to go grocery shopping.
You just throw it in a bag and throw it in the trash, right?
Yeah, and variety, right? You don't have to
Right.
eat leftovers.
Yeah, we got to get you married, Lane. You just got get some good home cooked meals here. No,
Well, I mean, actually, a lot of my good buddies, like they do, they have a chef come in once a week,
oh wow,
and they cook all the food for the family. I mean, that's if I remember my childhood, a lot of it was like, oh, our parents are busy because they're dealing with like going grocery shopping or food prep, and if you take, in a way, you can kind of take that all out of the equation, and then
Right.
you can get like, oh my God, there's actually time to spend time with the children now.
right?
You're gonna do
right.
it, you know?
Well, and again, I didn't want to sound sexist there. I mean, you could be the one cooking, for your wife or whatever. You know what I mean? That didn't.
Yeah, I mean, I have no problem cooking the bacon and bringing it home. So
yeah. Also, I mean, are the funds you're working with now are what you have grown from the beginning? Or are you still continually contributing to the pot, out of your salary, to grow your net worth?
Yeah, I'm still using, transferring old funds into syndications, but I always keep an eye on, like, at the end of the year, if I didn't invest, would I still be cash flow positive? And yeah, it's still a good, healthy amount. I mean, I imagine if I didn't do any investing, I'm sure I would save $10,000 to $30,000 a year.
That's great. That's great.
But I think that's the key, like I always, when I kind of do these free calls with investors just to get to know people, that's, I don't like to ask it out because it's kind of personal. I feel like for a lot of people, but I'm like, hey, dude, if you want the true advice, you got to tell me how much money you're able to save at the end of the year, because it really determines what trajectory and what strategy you employ here. I mean, if you're under 10, 15 grand a year and you don't have anything, you don't have any rentals, you really need to go get a single family home or wholesale, or, go find a better job or something like that, or cut your costs.
Right.
But if you're above, like, say, $30,000 a year, you're good. You're good at saving money. You're good at probably making money too. It's just a matter of investing in the right thing. And for you, since you're busy, you're probably better off into syndications.
Right. Well, what's sort of your long-term play? Where do you see yourself? Where do you want to see yourself in 10, 20, 30 years? I mean, you're a young guy. You got a long ways to go here.
Yeah, I mean, I think something I think about a lot, and I'm starting to see it being in about, I don't know how many deals I'm in at this point, but almost 10, right? Like, so I'd say, there's this phrase called the new rat race. So, like, people are always like rah about leaving your day job, but then you realize that you've created this other job on the backside of it as an entrepreneur, and at the end of it, you just wanted the time freedom and to kind of do whatever you wanted, but you've kind of created this alternate universe for yourself. So I'm always kind of thinking about that, and trying to make doing things as passive as I can. And I think once I build up, to 12 or 15 of these syndications, it'll be in a good place, I feel like. And at that point, I just wait for the syndications to kind of run their business plan and cash out, and then replace them again. But it'll be more on like a maintenance kind of a thing, as opposed to like a few deals a year kind of a thing.
Right. That's great. Well, we kind of zip by here on our time, but this is great because this is a little more laid back. Having you on, if you want to find out what Lane's favorite books are and websites and what's so forth, there'll be a link to his previous interview.
You can hear me bark like a dog.
Well, you still got to do that. Okay. Oh. I know, Lane. You've had a lot of time to practice. So I'm really hoping this is going to be, because, they have dogs in Hawaii, right? I mean, you could, right? Are there dogs out there? I mean, like a native dog? Don't they call them howlies? No, I'm just kidding. It's a bad joke.
We have a lot of dogs in the apartment here. So, okay. Well, just hopefully nobody wakes up.
Okay, let's give it a shot. Come on.
Okay. We have small dogs here, Bill.
Yeah, that was
kind of expensive to live in Hawaii. It's a price of paradise.
Dad, not even close to a Hawaiian dog, but that's okay. Well, Lane, I have really enjoyed having you on. This is great talking to you.
Yeah, thanks for having me, Bill.
Yeah, we didn't even get to talk about your electric bike. You're trading in your car for an electric bike. I mean, I think that's pretty exciting stuff.
Yeah. We can talk about that one real quick.
Yeah, I mean, I think that's a great idea. I would do it if, it wasn't so hilly over here. Actually, I guess it'd be great with the electric because you could just you could pedal.
I'll let you know how it kind of kicks in up the hill.
Yeah, that's what I want to hear. And if it can get over the, steep hills, I might be in on that one.
And if it lasts more than 3 months.
Yeah, that's the other part of it. Because they aren't cheap, those little electric bikes,
Yeah. But if you can return it to Costco if it starts like going bad on you, I think that's your hedge.
Oh, that's the trick.
Right.
You got to get it through Costco.
That's why you go into these stabilized property, right? That's your hedge. It's your cash flows. So that's what I'm doing with these bikes.
I love it. All right, Lane, I got to get out of here, but and I know you've got to as well, and maybe go back to sleep. I'm not sure what time it is back there, but in any case, thanks for meeting with us and updating our listeners out there.
Yeah, good chatting with you, Bill.
How can people get a hold of you?
Just email me at lane@simplepassivecashflow. Check out the podcast, and I've got some pretty good goodies coming out, like guide to living in partner investing and how to buy a turnkey book. Hopefully, I can get that done by the end of the year. So yeah, sign up for that and get news on those projects.
All right, we'll get some links on there for the freebies and for your website for everybody listening. Well, I want to thank you again, and I also want to thank all our Old Dog listeners out there for joining us today. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we greatly appreciate it. And please note, everything we discussed here will be outlined, and these links as well to Lane's site and some of the freebies he's got at the Old Dogs website at olddogsreinetwork.com/blog. And you're going to look for the episode with Lane Kawaoka. So that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.